Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome back to another episode of the Deal Deep Dive segment on the Westside Investors Network podcast. I'm your host, Trent Werner. In this segment, our featured guests will share their unique stories on a specific deal they've invested in. We will dive deep into finding the deal, financing the deal, writing an offer, and the due diligence. Do us a solid and smash that subscribe button, leave us a rating, and share this episode. And now, let's dive deep. Welcome back to the Westside Investors Network podcast. I'm your host, Trent Werner. On today's Deal Deep Dive episode, we're joined by Chris Lento of EM Capital. Chris is the founder and managing partner of EM Capital, and we're going to hear about his aerospace engineering background and his work in different defense contracts and all the cool stuff that comes with aerospace engineering. And we're going to hear about his personal portfolio, how he translated that into his own company, syndication company, EM Capital. And then we're going to cover a 67 unit deal in Kentucky that has plenty of hair on it and 5 property managers in 5 years. And we're going to hear how Chris handled that and when he knew it was time to make the change of property managers. Now let's welcome Chris Lento. All right, Chris Lento joining the Westside Investors Network podcast today. Chris, thanks for taking the time to chat with us.
Yeah, I'm happy to be here, Trent. Thanks.
Well, today, Chris and I are going to chat about his career and then a deal in Kentucky, which we'll get into in a little bit. Chris, you have a journey that a lot of people have where you had a previous life, a previous career before real estate, albeit kind of tied into real estate. What was your career before, investing in a bunch of different real estate deals?
Yeah, so prior to starting my own business, EM Capital, I was an aerospace engineer for 17 years, working on primarily defense contracts. So mainly actually guidance and navigation systems for submarine-launched nuclear missiles was really the primary thing I worked on for years. Yeah, very different than real estate. However, right out of college, I quickly got interested kind of in the real estate market. Boston real estate has always been really hot, so everyone's sort of aware of it. And, I very quickly started looking at what is this? Who owns this property I'm renting right now? And how did that work? And how did he buy it? So within 2 years after graduating, I bought a 3-unit in the Boston area and sort of grew my portfolio on the side with really no intention of ever going full time. It was just sort of a side activity.
Well, and a lot of people find themselves doing that, right? You want to expose yourself, invest in real estate, and then all of a sudden you kind of become hooked and end up wanting to do it full time. But Not everyone is an aerospace engineer going into real estate. A lot of people are civil engineers or have other jobs. I feel like aerospace engineering is probably pretty cool. Am I wrong?
I mean, yeah, there's ups and downs. It's like any, kind of engineering job. There's certainly, I got to do a lot of cool kind of defense oriented stuff. I got to work with F-15 fighter pilots on testing out some of our systems, and I got to go on a submarine once. So there's cool stuff like that. But then there's a lot of bureaucracy. The programs are big. They're very slow. They don't change very fast. I mean, we had, 10 years ago, we had plans that went out to 2080 because that's like the hull life of certain submarines. So they had to have, it was just like 2080. Come on, I can't, it was just ridiculous.
Yeah.
So there's pluses and minuses. Like the size of the programs just make it so it's hard to make an impact, I guess.
Right. And at what point did you decide to go full time in real estate and start EM Capital?
So I moved to DC in 2012 to be sort of a customer liaison with the Navy. So I still worked for my company, but I was like a technical resource within the government. And I got to see the procurement side of it, which was really interesting to sort of see, what our customer, the Navy, is looking for out of our contracts and what levers they have to pull and who they answer to. And it gave me a good perspective of like the whole kind of defense industry. And after coming back from that, I really couldn't see a position I wanted to be at in say 5 or 10 years. Nothing, I just had my daughter and everything involved kind of West Coast travel and a lot of, as you climb the ladder, it's just a lot of in-person meetings with the major defense contractors. And a lot of them are very, not political, but they're not very productive. And it just was not a career trajectory that I was excited about anymore. And at that point, I really said, all right, what's my plan to transition? And I'd already been ramping up my portfolio at that point. So I said, all right, in 2 years, I want to be in a position where I can leave this job and go full time.
And how many
So
units?
I guess short answer is like I got to a point in my career where I wasn't excited anymore about the next steps.
Which is a natural progression for a lot of people. How many units did you have in your portfolio when you decided to, make that leap?
I had 30 units.
Okay.
24 of them in Florida at like, kind of lower cost units, like 100K a unit. But the other 6, actually, I had the other 12 in the Boston area. So those were more expensive units. They were like in the 400K a unit.
Okay. But you weren't just holding on to the triplex and, making the leap with not a whole lot of experience. You had plenty of experience buying real estate before starting EM Capital and, managing it, operating and all that jazz.
Yes.
Okay. And what made you want to get into the multifamily space as opposed to different asset classes, commercial, storage units, whatever you want to, whatever the other asset classes are?
Yeah, no, good question. I think a couple of reasons. One, just familiarity. Like everybody has rented likely in their life. You graduate college or you graduate high school, you need a place to live, you rent. So one, it's a familiar asset class. It's easy to understand. It's kind of easy to see the demand. There's population growth. You're going to need more housing, and everyone needs it. So I think for one, as a start, familiarity. And then, as I've been in it for a while, I've looked at other asset classes, and I'm interested in, some flex space industrial and some retail, but multifamily specifically in the housing constrained environment right now is just a solid bet. We need more housing. We're not building enough housing. No one's solving that problem anytime soon. So that's where I think the focus is for us, at least for the next 5 years.
Right. And how did your aerospace engineer background, what skills or what, teachings that you learned doing that have transferred into EM Capital and your real estate business?
I would say project management, subcontractor management, just general organization skills. Not a lot of specific, engineering knowledge base, and I've always been very kind of mechanically inclined as well. On my early units, I did a lot of the construction on them, or I managed directly a lot of the construction, and some of them were pretty heavy construction projects. So just knowing, the details of the properties, and I think, and then general project management, schedule, budget. I was a program manager for pretty large programs for a decade.
Right. And I know you've mentioned, so your personal portfolio was in Florida and Boston. Looking at EM Capital's holdings that are kind of sprinkled all over the eastern side of the United States. How do you guys pick markets to invest in or target?
Yeah, so pretty early on, I was introduced to the concept that, not every market is the same, right? Boston's a decent market. It's a low cash flow market, kind of high speculative appreciation market with low cap rates. And that was the world for a while. And then I was introduced to the idea that, okay, there's other markets that maybe have less appreciation potential, but higher cash flow. And then there's like these Goldilocks markets that have decent cash flow and will have good appreciation. And I really like that idea to try to find those markets. So to test it out, I 1031 exchanged a property I had in Boston to a city about an hour away, Salem, Massachusetts, which had kind of higher cap rates, but a lot of appreciation potential, and went, third-party property management and tried to treat it like it was out of state. So I was like, all right, I'm going to go to this property once a quarter. When there's an emergency, I'm not going to deal with it. I'm going to call the PM and, go through the steps. And that was a good learning experience for me. And it kind of tested my model out. So then I took that property and 1031 exchanged it to Florida, to Tallahassee. And then it really sort of, I did only go down there probably once or twice a year. So after that, I was convinced, okay, I can remotely manage these properties and I can target markets. So to answer your question, then I try to figure out, well, what markets do I want to target and what are the criteria? So I want generally a major market. So 200,000 people plus in population, just because, that generally ensures a pretty good economic base. It's not just like one factory or one, major employer. And then beyond that, I wanted pretty consistent population growth for the past 3 to 5 years with a solid indication that it's going to continue, which generally means that jobs are moving there. And the Southeast is just, at least for the East Coast. The other thing, I want to stay east of the Mississippi because I want to be able to get to and back from my properties in a day if I have to. And there's enough population on the East Coast that I didn't need to look at Phoenix or Texas. Good markets, just harder to get to, and there's plenty of opportunities on this coast.
So you've talked about the job data and everything that you target or look for. Are there any financial metrics that you're looking for in terms of cap rate, cash on cash return, any of those?
Yeah. So, once we have the major markets, we start, and then we try to concentrate, right? Like I'm not looking at every market that meets that criteria. I try to pick 3 or 4 to get to know better because you can just underwrite them faster. You're like, oh, the Northeast of that market's bad, a lot of crime, just not even worth it. Don't spend the hour digging into it. So then, once a property meets the location criteria, it's in a neighborhood with a area median income that meets our threshold for that city that can support the rents we want. We look for 1985 build or newer, based on recent experience and just ease of management. And then once we start underwriting, we generally try to underwrite to what we think our investors' appetites are. So, for example, typically we try to get to a price where we can give our investors a 7% pref return with a, say, 13 to 20% annualized rate of return, depending on the market. So when the market's hot, maybe it's higher, and when the market's tight, maybe it's in the lower end. And we're constantly kind of talking to our investors like, hey, here's what the market's doing. The returns are a little bit lower right now due to interest rates. Are you still interested? And, based on that, we update our underwriting criteria. So it's really, the cap rate matters. But at the end of the day, it's what do we think our business plan can produce from an investor return perspective.
Okay. And then do you have a certain number of units that you are targeting?
Yes, but I generally try to look at it from an acquisition price because different markets will have different, costs per units.
Yep.
But we want to look for units for properties that are 12 million to 35 million in acquisition price. So, really expensive market, that might be 50 units, but another market, it might be, 200. So, but in general, we want to be over the number of units that can support a full-time on-site property manager, which is, I would say 80. It's kind of the minimum for that.
I'm glad you brought that up. Last conversation I had, we were talking about the same exact thing, and I asked him what his on-site number is, and he said 75 to 100 is kind of the ballpark. So right. You confirmed that.
I have a 60 unit that we have an on-site leasing agent and a part-time handyman.
Okay.
It just makes it more complicated.
Yeah. So my follow-up question to the, you analyzing and finding different markets to invest in. Once you find a good market, are you going to continue looking there, or are you always trying to broaden your net and look at new markets constantly?
Try to look at new markets every 6 months. So try to set aside a day to say, all right, do the markets we're in still work for us? Do we want to expand to another market? There's huge advantages to just knowing a market and having a reliable property manager in that market, reliable subcontractors, landscapers you can go to and that they're going to get reasonable prices, and they know that you have multiple properties in the area, so they're going to kind of give you volume prices rather than one-off prices. So there are a lot of benefits to having the economies of scale, but at the same time, if a market has peaked or is showing signs that it's no longer what I was looking for in the first place, you want to be able to pivot. So about every 6 months, we sort of sit down as a team and say, all right, let's look at the markets we have. Any new markets come up. There's a Milken report every year called the Best Cities Report. I always read that. Interesting to kind of see what they think the emerging markets are. There's a number of different, reports coming out, best cities reports, IRR insights is a good annual report that I like to read. So yes, we're constantly evaluating, but at the same time, I want to keep a small enough group that we can understand the markets. I've met people that look like all over the US, and I just don't know how you can do that without a huge team.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more. Exactly. And the reason I asked that is because personal experience and other conversations I've had tells me that getting to new markets can be difficult in terms of building relationships with property managers, contractors, brokers. If you're only looking at on-market deals, you might not get the best deals. So how do you and EM Capital go about building those relationships when you are expanding to a new market?
Yeah, good question. So first, we try to leverage the relationships we have in other markets. So a lot of times, these brokers are regional. So you might say, hey, I'm starting to look in, I don't know, Spartanburg, South Carolina. Do you guys have an office there? Is there anyone in your office that covers that area? So that'd be one. A lot of times property managers are regional or might have different offices around the region, or might know other property managers that they are friendly with and do a good job. And then they can tell you who's active brokers in the area, insurance companies. So basically use the network I have of lawyers, insurance companies, brokers, property managers to get recommendations in the new markets, and then start looking, sign up for a bunch of broker websites and things like that to get their deals, and then see who's transacting. So who are the most active players in the market?
Yeah.
And then I like to target 5 and just start reaching out to them, kind of introducing myself, leveraging my prior track record, and establishing a relationship and letting them know, we'll underwrite deals quickly. We'll give you feedback on why we don't like the deals, which is, the majority of them, right? Like you get 100 deals, maybe 90 of them look interesting. Maybe 10 of them look interesting. And then start developing that relationship and giving them, a clear buy box. This is what we're looking for. This is not what we're looking for. So that's sort of the process, and then build from there.
I really like that strategy because you do focus east of the Mississippi. You are able to leverage those regional relationships versus someone that is looking at every single market across the country. That's a great idea and a great strategy that you just shared.
Thanks.
So now let's move to EM Capital. So you said you started in 2012, 2014?
2017.
17, okay. Where is EM Capital now in terms of assets under management, number of assets held, units? Do you have any fun facts you can share about it?
Sure. We have 600 units under management across 8 assets, and they're just over 100 million in value. So that's where we are now. We did 60 million in acquisitions in 2022, which was by far the biggest year. 2023 was completely dead. I think we did maybe like 5 million, did some smaller deals. And then 24, we're selling out an asset right now, and we're under contract for our largest deal to date. So hopefully we'll close that this year, if not early next year.
Very nice. And speaking of some of the EM Capital assets, today we're going to talk about a 67 unit deal in Kentucky. What can you tell us about this 67 unit deal in Kentucky?
Sure. So this is the first deal I syndicated. It's a 67 unit Class C deal in a tertiary market south of Louisville. So I would say this is a big lesson learner. I came in, I'd recently gone on my own, was itching to get a deal done, had built up an investor network that knew what I was doing and was, interested. and I was joined through a real estate investing group that I was involved with two women who had a deal under contract and were having trouble raising. So quickly evaluated it. It seemed like a great basis. I was a little iffy on the market. It did not fit that criteria. It's not a 200,000 person market with, great indicators of job growth and population growth, but it wasn't a bad market, but it was certainly tertiary. We met, I liked them, thought we could work together, and we bought it. So that was 5 years ago, almost 5 years ago this summer, and it's been a roller coaster. So I guess the one problem has been consistently 67 units in a tertiary market is very hard to manage. Full-time on-site. Well, so in a lot of these tertiary markets, you have the apartment buildings are locally owned and locally managed. There's not a lot of quality third-party property management just because the population's not there or the number of buildings are not there to support them. So you have a lot of condo managers and you have a lot of people that can manage like 20 unit buildings, sort of with an offsite model where there's no one kind of sitting on the property. And then at 67 units, it's right on the edge of being able to, and it's a lower rent unit. Like when we first bought it, 2 bedrooms were $625. So it's inexpensive.
Yeah.
I think we got it for $28K a door. So we had a very low basis.
Yeah.
But it's just not a lot of absolute dollars to pay, a full-time handyman, a full-time leasing agent. So we went through 5 property managers in 5 years. And it was a journey from kind of bigger property managers that had minimum monthly payments that were just killing us to we hired just W-2 employees. We hired a full-time property manager and a full-time handyman that effectively worked for me. And then I hired kind of a back office person from one of my other properties to work at night and sort of make sure those two were entering work orders correctly and, reconciling the books and doing all the stuff that, the back office of a property management company does. And I don't know how to do, nor do I really want to know how to do it. So basically I cobbled together a little property management company quickly to run it for a year and a half. That was the best it performed. But then, the handyman got another job. She got divorced and moved. And then we couldn't find anyone else. Went to another local property management company. They did a terrible job. So it's been just a challenge. We have a great property management company now, but it really took a long time to get there. And now we're finally selling. We're closing next Thursday, hopefully. Knock on wood.
Congrats.
Yeah. And it's been a journey. I mean, I've certainly learned a lot. I don't have a huge stake in it from a GP perspective due to my role coming in. But I've put a lot of effort into it, and I'm looking forward to closing the book on it.
Turn the page on this one.
Right. And the returns are going to be good for the investors. So that's huge. And that's been my focus for this property the entire time. Like I got my early investors into it. I had to make sure it worked.
Well, yeah. And no wonder you spent so much time on it because the first one is always one that you kind of hold a little bit more near and dear to your heart, especially for the investors.
Right. Exactly.
So, I mean, I think a lot of people have heard that bad property management companies can tank a deal pretty quickly if you don't do anything about it. It sounds like you did plenty to handle those obstacles that were presented to you, churning and burning through different third-party management companies. You said you went through 5 management companies in 5 years. At what point do you, especially for this property that we're talking about, make that call to say, hey, you're done. We got to go find someone else? What were the signs that jumped out at you that made you make those decisions?
I mean, usually it starts showing up in the obvious metrics like occupancy, collections, things like that. It's clear that they're not paying attention or they're not, fully focused on the property. We have weekly meetings, weekly Zoom meetings with all our property managers. Them not being prepared for those meetings, not really being able to answer questions. We always get property manager access to the back end of the whatever system we're using so that I can just dig. So I'll spend, half an hour a week per property, just sort of digging in, clicking into an invoice. What is this $1,200 plumbing invoice? Like, oh, it's cleaning like the kitchen sink. That's weird. Why is it $1,200? Just sort of like digging in. And then on the meeting, not to be kind of a gotcha, but if if they don't seem like they're on the ball, I'll just ask them things like that to see kind of what their answers are. And, what I'm really doing is confirming what you already know. Because I have a feeling, what I've learned is that, once you have that feeling like something's not right here, something's probably not right.
Yeah.
And you just can kind of tell by the way the property's going, things that aren't being handled. We have my assistant calls every property once a quarter and acts like a
Like your shopper?
prospective resident. Yeah,
Yeah.
exactly. And then gives us a report. And we have different softwares we're adding to our bigger properties where we can listen to the phone calls that they do with the residents. We have a whole list of them on the website, and you just kind of click through. Oh, this is a 3-minute call. What do they say? How are they presenting? And start looking at things like that. But yeah, I mean, kind of gut feel based on a lot of different metrics. And then, sooner the better. Like the minute you start feeling that, if it's a bigger company, go right to the regional management or the regional VP and say, hey, what's going on? I think we have a problem. I've had a lot of properties where we've changed our on-site. So, we kept the same company, just switched on-site managers. And every time I've gone to their upper management and just said, hey, is something going on? I'm not getting the response I expected, or there seems to be some issues. They're already aware of it. Yeah, there is. We've been trying to work in the background before we told you, but we think that they're not a good fit, and we're gonna, we've been looking.
Yeah.
Which I don't love. I'd rather be transparent up front. If they had an indication of that a month ago, I would have liked to have known that. But
Yeah. I mean, I've never heard anyone else say from on a ownership standpoint of getting the PM access to whatever software those companies are using. But I mean, we have in-house management, so I basically have that too. And
Right.
It's so nice being able to just go sift through, dive into things without having to wait for them to give it to you.
Yep,
So that's
absolutely.
a really good idea that I think a lot of people should maybe borrow.
Yeah, and we've never had a no. Sometimes we kind of like go back and forth with what permissions they give us.
Yeah.
Like one Appfolio PM company, I can see the invoices and I can see, say, like the resident applications, and another one I can't.
Yeah.
But typically we can work through it.
Yeah, no, that's a really good idea. So, Chris, going into this deal, I know you said you were kind of connected to some other GP partners on this deal. What was the, I guess, business plan for the 67 units here in Kentucky that we're talking about? Was it value add? Was it, just a buy and hold? What was the business plan going into this?
So going in, it was really a deferred maintenance, improved management, and stabilization plan. So the property had been owned by an older couple for 15 years. The husband had died. The wife was really just barely kind of holding on. So it had become kind of people weren't paying rent, and there's a lot of kind of weird stuff going on. So it was go in, kind of clean it up. We had a CapEx budget to do about 5,000 per unit, which is not much now, but in 2019 when we bought it, that wasn't a full reno, but that was like, clean it up and do a decent turn was the plan, but certainly not like new cabinets, countertops, anything like that. We also had we had a green loan on it. So there's a number of green initiatives that we had to do that needed to be sort of cleaned up after we got a hold of it. We somehow had green money to create energy efficient or to buy energy efficient hot water heaters, but the property was all electric hot water heaters, so they don't exist. So just some things like that where we had to sort of move the funds around and iron it out. But it effectively ended up being a stabilization. So, making the units nice, being professional, increasing the market rent, and just running it more as a business and less sort of as a hobby, I guess.
Right. Okay. And then, so 67 units, you said 5,000 a door, so kind of a light facelift from what it sounds like per unit. What is your target occupancy, and were you planning on spending $5,000 per unit and updating every single unit, or did you have a percentage of the units that you wanted to touch before turning it to the next buyer?
Yeah, so I mean the target occupancy was 95 plus. It's a market that doesn't have a lot of housing. and certainly not a lot of renovated housing. So we quickly found out that if we just painted things and cleaned them up and, put new carpets in, people were banging down the doors at market rates or even a little above. So that was good. Now, how qualified they were, even if they were qualified, whether they were going to continue paying after month 7 when their car broke down, that was probably worse than we expected, but the demand was certainly higher than we expected. And then, no, we didn't plan to do every unit. It was a little bit more, as units became available, we'd assess them. Some of the classics were kind of acceptable, and we would just re-rent them as is, paint the walls, light turn. And then some of the units had kind of some significant problems. And the property also had some foundation issues. It has probably like 4-foot crawl spaces under 3 of the buildings. And there was a lot of joist rot that we were aware of. So we got a good deal because we knew there was a pretty significant problem that we had to address right away. And that was part of our kind of initial CapEx plan.
And you said you acquired it at $28K a door?
Yeah, I think it was $28K a door.
And you're closing next week at?
Closing next week at 61.
Wow.
Yeah.
Whoa. Okay.
Yeah. But there's a lot of CapEx put in there along the way. And a lot of down months with those property manager transitions had some pretty big dips. Because if you have a subpar property manager and they get wind that you're moving on, it gets worse, certainly before it gets better. So, and then you find out all the problems from the prior property manager when the new one comes in. So, yeah, that sounds like sounds like a home run, but it's like a solid double maybe.
Yeah, you can't complain about an extra base hit.
Yeah, right, exactly.
Yeah. So the other question I have for you is you got a taste of the in-house management, right? You put together your management team for a trial run. Do you have in-house management now on any of your other assets?
We don't. And that's, I think, one of the downsides of having a distributed portfolio, not where you're located. And I've certainly, modeled out and thought hard about, do I want to switch to an on-site model? I'm definitely like an asset managed focused company. Like I like the project management. I would, not be opposed to owning a property management company or self-managing, but it's trying to figure out how to do that on a distributed basis and whether it makes sense, right? I mean, your back office is your back office, but having those boots on the ground in all these locations, is it worth it? Or do we have the economies of scale in any of those markets to really know the market? And that's where, a good third-party manager can really help. I mean, they know the competition, they know the market, they know the vendors. So not right now, but that's something we're definitely considering at some point.
Yeah, and I'd imagine it would probably make more sense, like you said, when you have the economies of scale in specific markets. If you have 100 doors in one market or 200 doors in a market where you can make it make sense across those different assets, that makes perfect sense. Well, Chris, we talked about the deal. We talked about EM Capital. We talked about you being an aerospace engineer. Is there anything else you wanted to share about yourself, your business, or this deal today?
Well, yeah, man, I guess one thing that I've found really exciting since COVID, at least, is that the pace of technology in the real estate market has really increased. And coming from sort of a technology background, it's exciting to see all these different third-party players coming in and, optimizing marketing. And, we'll see where AI kind of fits in for real in this game. It's kind of nibble around the edges here. So I think it's very exciting. And I think multifamily, kind of the business model is changing pretty fast. And I think that's going to be very interesting to see where it goes. The capital markets are changing. A lot more people are starting to invest in these kind of alternative assets. There's a lot of different vehicles to let people invest in a more liquid basis. So, a lot of changes, and I think it's generally for the better. So I'm excited to see where things go.
Absolutely. And Chris, where could people connect with you or hear more from you?
Yeah, the best way to connect with me is via LinkedIn. So Chris Lento or EM Capital. And then my website is emcapitalgroup.com.
And we'll make sure all those are linked in the show notes. Chris, thank you so much for joining us today and sharing about your background and your 67 units with a little bit of ebbs and flows included in that deal cycle. And congrats on closing on it here in the next week.
Yeah, we'll see. Hopefully next Thursday.
Fingers crossed. Thanks, Chris.
Yeah. All right. Thanks a lot. I appreciate it.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.